What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my stock market monthly update series for the month of August 2023. In each episode, I give you guys a quick update on the stock market and the economy by splitting the video up into three parts. In part one, we take a look at the current performance of the stock market and how things are going so far. In part two, we cover any broader economic news and updates that are affecting the stock market, which lately, of course, has mostly had to do with recession fears, inflation, interest rates, but also second quarter earnings season. So I'll give you an update on all those topics. And then in part three, we finish up with the biggest gainers and losers over the past month. And I talk about any individual stock news, and I also let you know if anything catches my eye there for possible investment as well. So it's a ton of fun. I love doing these update videos. It's kind of a easy way of me just giving you an update on all of my thoughts and how I feel about the stock market every single month. So I love doing these. I hope that you're enjoying them too, but let's not waste any more time. Let's go ahead and kick things off here with part one. Alright, so starting first here with market performance, of course the biggest factor over the past month has been second quarter earnings, which have really helped move the needle in a positive direction for the big three indexes, with the S&P 500 rising close to 3% over the past month, the tech-heavy Nasdaq rising almost 2.5%, and the Dow Jones Industrial seeing the best performance of all at over a 5% gain. And more importantly, when looking at year-to-date numbers and how close the indexes are to an all-time high, we can see that they continue to have a very strong year, with the S&P up over 17% and only down 6% from the top, while the Nasdaq is up even more at a 33% gain year to date, although it is also down a little more from the top too, at just around a 13% decline, which is typical for the Nasdaq to be a bit more volatile because of that heavy exposure to tech stocks and also more highly valued companies. But regardless, the point is that so far it's been a very strong year for the market as it continues to rebound after that post-pandemic crash. Initially, the stock market crashed because the pandemic started. Then it skyrocketed when we pumped all this money and stimulus into the economy. But then it crashed once again because of all that reckless spending, which led to really high inflation and rising interest rates. But now the market is rebounding once again, on the hope that we don't raise interest rates by too much and can actually avoid going into a recession and then maybe come out stronger on the other side. So that's actually a good place to just go ahead and turn over to part two of the video and cover all of these broader economic topics, which of course right now all eyes have really been on inflation, on interest rates, but also second quarter earnings, which give us some insight on how the economy is doing right now and how close we might be to that possible recession. So let's take a closer look right now. Alright, well, starting with interest rates first, there's a few things to update here since our last market update video, because you'll recall that back in June, the Fed had actually paused rate hikes for the first time in 15 months, after having raised them 10 times in a row right before that. However, what's new is that in July, they decided to once again return to raising rates with another quarter point hike, bringing it up to now nearly 5.5%, which is the highest it's been in over 2 decades, and you can see that better on this chart right here. And of course, the issue is that anytime that you raise rates this sharply, you typically hurt the economy by making it more expensive to borrow and spend money, thus leading to job loss, lower consumer spending, and an overall recession. However, this time is pretty tricky because our unemployment rates are actually still hovering near pre-pandemic and historic lows, meaning that people are still mostly employed out there and thus spending money, which actually helps keep inflation lingering on longer, and that's partly why the Fed continues to try to fight inflation with higher interest rates. As it stands though, inflation is actually coming down at a pretty fast rate, with June numbers already hitting 3%. For context, the Fed considers an inflation rate of around 2% to be healthy for the economy. That's kind of like their target rate that they want to get to. And we should be getting July numbers later this week too. So my guess is that if the trend continues and inflation takes another big dip for the month of July, then the Fed will likely start thinking about more pausing and maybe even lowering of rates by next year. In fact, the Fed seems to be pretty optimistic about the economy right now, as they no longer are projecting a recession, which you might recall they had previously forecasted for a mild recession to happen this year. As such, interest rate traders are actually pricing in an 87% chance that the Fed will pause rates in the next meeting, which will be in September. Although in the last meeting, Fed Chair Jerome Powell did say that they would be open to more rate hikes if inflation continues to linger on, but their decision will be data dependent from meeting to meeting. So it's pretty hard to speculate on exactly how all of this will play out, but I continue to think that the possibility of a soft landing is actually looking very strong at this point, where we don't necessarily go into a recession, but maybe just kind of narrowly avoid one, and then the Fed starts to ease up on interest rates going into next year, which boosts the economy and helps it rebound and return to healthy levels. That's a very real possibility. I could be wrong, of course, and I've certainly seen a lot of evidence from companies and their earnings reports that suggest that advertising sales are still struggling, that tech companies especially are still having a hard time coming out of the pandemic. There's still a lot of layoffs out there, and budgets are tightened and companies are spending less, which could send the economy into recession. But overall, broader employment is still looking very strong. So it's just a bit hard to tell at this point. We kind of just have to wait and see. But long term, like I've told you guys many times, anytime that we're in a high interest rate environment, I'm actually very optimistic about investing in stocks long term, because I know that that's just pure ammunition right there that can send the stock market soaring as soon as the Fed decides to lower rates. Meanwhile, though, earnings season for the second quarter has also looked much better than expected, with over 80% of S&P 500 companies having already reported, and about 80% of them reported positive EPS surprise, while 65% also posted better than expected revenues too. However, this is still technically an earnings recession, as we have over a 5% decline year over year for the second quarter, which is not only the biggest decline since 2020 when the pandemic started, but it's also the third quarter in a row of declines. And yet despite that, the forward PE ratio for the S&P 500 is actually higher right now than both the 5-year average and the 10-year average. In other words, the stock market is pretty expensive right now and could probably use a correction. Looking ahead though, the numbers do at least get better, as analysts project a return to earnings growth next quarter, followed by a very large jump in Q4 of almost 8%, which would actually leave the full year slightly positive. And then in 2024, that's when they expect the economy to really start roaring higher again, with a double-digit gain of 12% on EPS and another 5% gain on revenues too. To me, if that actually happens, then I don't think we go into a recession. I think that's a soft landing scenario. If analysts are projecting double-digit gains on EPS next year, that means that the Fed is probably lowering rates to boost the economy. And if that's what's going on, I don't think we end up having a recession there. I think it's very unlikely. So ultimately, we may not actually get the full-on stock market crash that a lot of people on the sidelines have been waiting and hoping for. But that doesn't mean that there can't still be a lot of volatility or dips here and there, or even a broader market correction at least, because I do still think that the market is very expensive right now. I think it's kind of priced to perfection when you look at the current state of the economy right now. And so if anything goes wrong, if inflation or interest rates linger on a bit longer than expected, if companies start reporting weaker earnings, I mean, there's broader things that can happen too in the world, like geopolitical conflicts or any number of things. But any kind of thing that goes wrong, I think does send the stock market lower. So I would still expect dips. Maybe a full-on correction is definitely still on the table too. Not a reason to panic. Not a reason to not be buying stocks. I'm still investing long term as always. But you can be sure that I do have plenty of cash on the sidelines too, because I do think there will be some volatility. And right now, stocks, for the most part are looking kind of expensive. So I do want to have some cash on the sidelines. If we get some dips, stock prices get more attractive, you're going to want to be able to take advantage of that. So not a reason to be scared or anything like that, but just be smart about it. That's what I would say. Anyway, just my opinion, not telling you guys what to do, make your own decisions. But we're running a little low on time here. So let's just quickly finish up here with the biggest gainers and losers of the past month. And I'll let you know if anything catches my eye there as well. Alright, and starting first here with the biggest gainers, there was actually quite a few of my own stocks making the list this month, including two of my spec stocks in NEO and Upstart, both rising by over 40% each. I'm really just holding these positions for now, but I do like NEO for the future of EVs, not just in China, but also their potential globally. And then Upstart is an AI-powered lending company that I feel has a lot of long-term potential as a disruptive fintech. Upstart is about to report earnings this week, but NEO doesn't report until next month. However, they've already been receiving positive news throughout much of this year, including some recent announcements like new Chinese subsidies for EV makers, as well as a big investment from Abu Dhabi. Carvana is another interesting stock here that rose by over 50% this past month. They're a used car sales company with those, you might have seen them, they're like these giant towers that look like vending machines for cars. And I really enjoy tracking this stock because it's a very wild one that absolutely crashed following the post-pandemic surge, but then rose over 800% this year. So it's just been all over the place. Financials are also pretty wacky with exploding sales the past couple years, but negative net income that actually got worse last year, and then a revenue drop of 20% expected this year too. So it's a little too wild and volatile for my taste, but I do love tracking it for fun. Let me know if you guys would want a full analysis video on this one though, because I think that would be a fun one to do. Another interesting stock to rise though was the streaming platform and now smart TV maker, Roku, who rose by over 40%. But while Kathy Wood is a big believer in them, I think there's much better and safer and more diversified options in video streaming like Disney or Amazon. So I've never purchased the stock myself. Scrolling down further though, a couple more Chinese EV companies rose with XPeng and Li Auto at around 30% gains each, mostly because of those Chinese regulatory tailwinds. But not much else is going on this page, and scrolling further down, not much on this page either. Maybe some of you own Restoration Hardware. They rose over 20%. I'm not too interested in that one. But then scrolling even further down, we at least have US Bancorp, one of my newest pickups this year, and I know several of you went along for the ride with me on that one. So it's good to see them rise. Just really a solid kind of all-around bank stock that I felt was oversold after the SVB collapse. So a rebound here makes sense, and earnings were also pretty good for them too, so I'm happy to own that one. And then there was Elf Beauty, a popular cosmetics and makeup company, DraftKings, a popular online sports betting company, and WestRock, not a super popular stock, but they're a pretty well-established name in the paper and packaging markets. And all of these rose close to 20%. I don't own any of those myself, but WestRock would probably be my favorite because they at least have a 3% dividend. And then finally, scrolling just one more page down, we can see that SoFi also made the list, which is a very popular fintech that I love owning. And I know several of you own that stock as well. But they had a very strong earnings report recently as they continue to gain members, deposits, and they're stealing market share from bigger banks. And so the stock soared by over 16% as well, which I'm happy to see. I plan on holding that stock very long term. All right, turning over to the biggest losers though. First one that caught my eye here was Fortinet. Somewhat of a popular cybersecurity stock that fell 22% this past month, which was entirely caused by the recent earnings report that sent the stock crashing by 25% in a single day. In the report, Fortinet pointed to a weak macroeconomy and even lowered their guidance because of economic uncertainty. However, several analysts have actually come out since then and say that the stock is a buy on the dip. There might be something to that, by the way, as cybersecurity is a very high growth market, and I think it'll only get bigger over time, and you can clearly see that reflected in Fortinet's very impressive financials over the years. However, just keep in mind that the stock is still up about 300% in the past 5 years and almost 20% year to date, even after the recent drop. I love cybersecurity stocks, but I just wish they were cheaper. Fortinet, for example, trades over 60% more expensive than the sector on a PE ratio basis. Not much else on this first page though. I did notice Norwegian Cruise drop. They actually had a pretty good earnings report, but I think travel stocks were already too high going into earnings, and many of them gave weaker guidance than what Wall Street wanted to see, so a correction was likely to happen. And actually, if we scroll down a little further, you'll notice that a bunch of airlines also suffered the same fate. The only travel stock that I kind of like right now though is United Airlines, but they're still up over 40% this year, so I'm waiting for a bigger dip before even considering a small entry in that one. Speaking of airplanes though, Joby Aviation also fell about 15% this month, which is the flying taxi company that was actually on last month's biggest gainers list. And in fact, I think they were ranked number 1. So a pullback here does make sense. I think they had rose by like 80% last month, something like that. So now they fell a little bit. It's like a little correction here. For me though, this stock is too speculative as they don't even really have a product out on the market yet, but are still spending hundreds of millions of dollars, and they already have a market cap worth almost $6 billion. Also on the list though was Moderna, who continues to struggle coming off the pandemic because of the lower demand for their pepperoni V-shot, but I think Pfizer is a much better stock option and they pay a really good dividend. The American EV company Lucid also fell about 14%. I really don't have any faith in that company long term though. You guys can let me know if you like it, but I've never really considered it. Tencent Music also fell about 14%, but I like the regular parent company Tencent much more, and I own that stock. Legacy automaker Ford also fell about the same amount, but I prefer GM stock, General Motors, which I think has more diversity across their brands and overall lineup, and I actually purchased a small amount of it recently too. It's one of my newest pickups. Another cybersecurity stock in Palo Alto Networks also fell this month by about 13%, and while I don't own it myself, I do actually prefer them over Fortinet, with the cheaper PEG ratio that is also cheaper than the sector as well. And I'll just finish up here by scrolling a little further down. AT&T stock fell over 10%, but I prefer Verizon, who is actually on the list too at just under a 10% drop, and they have a mouth-watering dividend right now, that has risen to the highest level I've ever seen at above an 8% yield. It is high risk, but man, that dividend is just so tempting that I've been buying some of the stock myself in small amounts. And then finally, Tesla also sank about 8% this month because of a drop in their margins. But I feel that that's really just a temporary issue. They were doing a lot of sales and stuff, and I actually think earnings were very strong with over a 40% gain on sales and 20% in profits. However, it's already my second biggest stock, and they're still up over 100% this year, so I'm kind of just holding it for now. I think I'll stop here though for the sake of time. I try to keep these videos within 15 minutes and we always go over, so I apologize for that. But regardless, I hope that you enjoyed the video. Thank you so much for stopping by. Please support the channel. You can do that either on Patreon or just by hitting that like button, subscribing to the channel. All those things really help me out a lot, help keep this channel alive, and it means a lot to me, guys. So thank you for all that support. But I will catch you in the next video, my friends. Drop your comments down below. Let me know how you feel about anything we talked about. Hope you're all doing well. Take care. Bye-bye.